Welcome to Internet Capital Markets, the weekly show where we explore how financial systems are being rebuilt on the internet, open, global, and programmable. Each week, we sit down with builders, investors, and institutional leaders who are shaping this transformation, from tokenized assets and decentralized finance to real-world adoption and the infrastructure powered by the next generation of global markets. I'm Jeremy Pozzetto, and together with my co-host and co-founder, Jonas Zurman, we are builders ourselves. Today's show is brought to you by Trustbytes, smart treasury for internet capital markets. We are witnessing a historic shift, and how our guest today would call it the protocolization of capital markets, where finance is moving on chain with less friction, expanding access, and redefining trust at internet scale. This is just not about technology. It's about how finance itself evolves and becoming natively digital. Our guest today perfectly embodies that frontier spirit. Pete Townsend has spent decades at the crossroads of traditional finance and digital assets, from leading innovation as digital asset manager himself to investing in founders and startups who are bringing finance on chain, first with Techstars, now with his own firm, NorioVentures. Pete is also the host of Money Never Sleeps, a long-running show that dives into the minds of founders at the intersection of startups, enterprise, Web3, and fintech, exploring what drives them and what keeps them awake at night. So let's find out today what keeps him awake at night, and we'll explore how Pete sees the evolution from managing assets digitally to managing digital assets, and why he believes the whales are finally ready for institutional scale. Let's dive in, and welcome to Internet Capital Markets, and let's welcome our special guest today, Pete Townsend.
Thank you, Jeremy. Thank you, Jonas. Awesome to be here with you guys doing this. I feel like it's definitely flipping the script here, because I'm usually the one who's interviewing founders and that are on an awesome trajectory like you guys. So it's great to be here doing this with you. So thank you for asking me in to do this.
Thank you for being here. We are at a point in time where institutional capital markets are merging with internet capital markets. And now that we have you here, Pete, and you've actually lived it, we'd like to explore how your personal journey to the broader transformation that's actually underway to the internet capital markets. Pete, you've often said publicly that in 2016, you've boarded a non-stop flight to the next frontier of finance. What did that frontier look like back then in those old days, and how has your understanding of it evolved today?
Yeah, it all depends upon your point of view, right? In that in 2016, I was just finished my 20th year in traditional finance and TradFi. And 2 years before I left, I got very excited, enthusiastic about blockchain and about where it was going. But the tone very much back then was love blockchain, hate crypto. And so navigating that was very interesting, because what happened is that you had the CEOs of a lot of tech firms, a lot of financial firms telling their CTO to go out and investigate this blockchain thing. And they came back from the frontier and said, well, mining and consensus algorithms and all of this, we don't need that. We just need assets to be fully digital in form. And so what they did was that they set off trying to build permissioned blockchains, enterprise DLTs or distributed ledger technology kits. And that kind of missed some of the point. And so the tone was very much around, okay, we understand the view towards crypto. And one of the biggest misnomers, and I've always said this, is that I wish it hadn't been called cryptocurrency, because originally back in 2009, that was the intention. Peer-to-peer electronic cash was, at the top of the white paper for Bitcoin. But what it really is an asset. It's a crypto asset. And so, back in 2016, it was, I had people that were saying to me when they couldn't believe that I was getting into this space, they were like, Pete, you like, do you realize what you're doing? Do you realize what you're getting yourself into? It was, it was a bit too dramatic, but it was an interesting space way back when, very nascent, but 2016, 2017 timeframe was one of the first big uplifts that we did see in institutional interest, and I'm glad I was there at that point at the beginning.
Mm. Yeah, those were really exciting times. And yeah, curious how it is actually evolving. Now, you've spent years at the intersection of finance systems, venture, startups, and this is actually how we met each other. Where do you see the biggest disconnect today between traditional finance, how it's narrated today, and the on-chain financial reality?
Yeah, I think it's all a bell curve, and there are, if you look at the financial institution community, it's, and drawing it with your finger, the bell curve. And
Mm,
there are people that are on the right-hand side of the bell curve that have opened their eyes, or their eyes have been opened for them to the realities of moving finance on chain. And there are those that have not yet had their eyes open to it, or are purposely keeping their eyes shut because their perception of the space is just that crypto is a casino, and they haven't yet come up along the curve. And so anytime that I'm looking at what type of enterprise would be able to be a suitable partner for a young and upstart startup building in this space, that you'd want to focus on and target the firms we already see folks in the innovation lab, for example, of a big enterprise corporate financial institution already talking about crypto and digital assets and tokenization.
mm,
So the disconnect is really on perception, in that
mm,
from the traditional financial systems and institutions and enterprise, people just haven't, the vast majority have not cared enough to bring themselves up the curve and educate themselves on this, or have their institutions or their employers educate them on this. Coming from the other side, it is so funny that um, you get yourself into a chat group with a bunch of crypto natives, and you start talking about stock splits, and they're like, what is that? You
mm,
know, what are all these funny little tradfi things that exist in the world with how markets operate? And that is just from the path that they chose, the path that they grew up on, and the path that, they might have started out as a developer, learned a bit about finance, but haven't got into the depths of how financial markets really operate. So coming from the other side, kind of the misperception, or misinformed view is one of, hey, we can just move all of finance on chain, or everything that we've built in crypto is immediately transferable into the financial markets. A lot
mm,
of it is, and we have all the crypto pioneers from the last 15 years to thank for that, because a lot of them built with this great big vision in mind of, this isn't just for crypto assets. This is for, let's bring traditional assets on chain, and that they've built with that vision in mind. But you can't do everything, because if you try to do everything, you're boiling the ocean. You're not
mm,
going to build in 2016 the types of trading utilities that you need in order for quantitative hedge fund managers to be able to trade on chain. You're not going to do that. With what you're going to do is try to develop that market and bring people on board, then build as needed.
mm,
So there's still a lot to be done, a lot to be built, and that's why one of the core themes that I'm still looking at is infrastructure. People are like, "Well, we've built so much infrastructure, let's just get some volume in here." I'm like, "We still need a lot. We still
mm.
need a lot for traditional finance to truly come on chain." So what I really like to do is try to connect those dots and bring the people from the institutional side into the crypto and tokenization language, and bring those from the crypto native side into the institutional language, and just to try to bring everybody together and make it easier for this transition to happen.
Thank you so much. There's an education gap, there's infrastructure to be built. Now let's switch gears a little bit. We'd like to dive into internet capital markets themselves, as we are collectively rewriting Wall Street operating manual. So let's go deep into RWLs, the main ecosystems and all that, and handing over to Jonas to ask some interesting questions.
Yeah, happy to. So I feel like especially the crypto market and the entire ecosystem is like very good at like coming up with all these cryptographic terms, right? Internet capital market is maybe another one here. So my first question would be, what do you consider as internet capital markets today? And do you think it's like solely related to crypto or digital assets? Or is it like even starting earlier, maybe even with digital banking and the neobanks all around the world?
Yeah, that's a good question, Jonas. And I sometimes refer to the stage that we're at right now as FinTech 3.0. Okay, the world doesn't need another 3. You know, we've we've had the big one with Web3, but just to kind of simplify things, FinTech 1 was the old school enterprise banking technology that was originally built in the 1960s and 70s, and that's where things like NASDAQ came from. That's where things like American Express came from way back when, and all of the COBOL-based platforms that where folks get pulled out of retirement to still code in COBOL. Now that may be gone by the wayside now that AI can code in COBOL apparently. So, but that was FinTech 1.0. FinTech 2.0 is with the evolution of mobile and cloud together, where we're able to have our financial lives in the palms of our hand with FinTech apps like Revolut, Robinhood, Venmo, PayPal, you name it. All that really is, though, is just a new UX or user experience on top of the legacy platforms. And we're still moving money through these siloed channels. If you're using Venmo, the reason it moves so fast is that it's a closed network, is that you're just moving from one Venmo user to another. So the Venmo platform can support that and move things as quick as their software can enable it to move, because it's not moving on any external rails. Once you offboard, that's where you need to get out, and that where you go through the regular, financial systems. So that was FinTech 2.0. FinTech 3.0 is where the assets themselves are internet native assets or truly digital assets, is that they don't exist in analog form offline, like an equity, a share of stock, a bond, options, futures don't exist in material form. Stocks and bonds don't exist in material form really that much either, unless you still try to get an old school stock certificate. But they are still booked really in street form, and that you need to reconcile across all the different institutions that may have an interest in those. And where if you look at any single trade in the equity markets, for example, you've got an initial booking broker, a buying broker, a selling broker. You've got intermediaries between them. You've got custodians, and everyone has a different view of the asset. The difference with digital assets is that the trade is a settlement, is that when you trade that asset, it is atomically settled. And so there is no who has what records. There's just one source of what is held in what account, in what address, right? And that's it. So being able to have these natively digitally issued assets, that where that asset moves, that's the only actual instance of that asset, that makes the big difference on FinTech 3.0, and that it allows you to do away with all these extra layers. And so, that for me is kind of how we've developed and got to this point. And what's enabled FinTech 3.0 to take hold is crypto. Cryptographically secured assets is the way that I like to say it in long form rather than cryptocurrency, because that's what they are. They're assets that are secured by cryptography, and that makes all the difference.
No, I absolutely agree here. And actually, we see that evolving. I mean, if you look at the major fintechs, especially like this year, maybe even like in 2024, they are all moving like into the direction of like, let's call it crypto digital assets, probably led by Stripe. Now you also have like Revolut, obviously, where you can have your crypto assets, even where you can now withdraw your crypto assets. So it's like really merging together. And I do believe that we do see like a digital banking that is like actually on chain.
We do.
But like touching on that, how do you see all that evolving as more and more assets get tokenized and TradFi, on the other hand side, gets access to crypto native assets? What is your ideal scenario here?
Yeah, I think why it's happening now, first off, Jonas, is that back in 2016, 2017, like I mentioned at the start, that institutions got excited about blockchain and they started to go in one direction with that. And then we had the slowdown in the crypto markets, the bear market of 2018, 2019. It picked back up in 2021 or 2020 and 2021. And we had institutions back at the table. And all the time you hear about this institution launching another crypto trading desk, that institution launching another crypto trading desk. But it never really got into the tokenization of assets or creating these natively digital assets that are real world assets or equities, bonds, and other types of assets. Because you can tokenize something, but if there's no market in it, you're just tokenizing it for the sake of tokenization. You can't reuse that asset. You can't, if there's no market for someone to buy that asset that you've already issued, or no market for that, even if you do get a buyer for that tokenized equity, finding someone to then sell it on to, you need liquidity, you need a trading venue. And those things just didn't exist yet because the crypto exchanges, the centralized crypto exchanges, were all just geared towards crypto, and that's it. And that's all they could trade from a regulatory perspective. There's so much regulatory uncertainty around this. What happened since then is that we now have regulatory clarity. We also, a big push on that had been the launch of Bitcoin and ETH ETFs, in that the institutional adoption of crypto started to go in a significantly up into the right direction. And so we had institutions becoming more familiar with trading these types of assets, more familiar with holding them, more familiar with what are the compliance frameworks we need to have in place for all of this. And that, for me, was one of the big unlocks. And then with now the Genius Act around stablecoins and also the growth of stablecoins in general, if you want to hold and or trade in digital equities, for example, or tokenized equities, are you going to really do that with old school analog fiat, or are you going to do that with digital money? And you're best off to do that if you're going to settle, if you're going to be trading, you're best off to do the off ramp into stablecoins from whatever you're trading in the markets. Okay. So you had the regulation, you had industry adoption, you had the growth of stablecoins, not just because they were good from a trading perspective, but they're solving problems around the world. For example, in emerging markets, where it's more reliable for people to be able to save and to invest in the US dollar than it is for them in their local currencies. And it's not yet overwhelmingly the majority, and where we see that huge critical mass of an emerging market economy where everyone is leveraging US dollar backed stablecoins, but it's still a big enough trend to point to say, okay, there are a number of things happening here from a societal perspective around the world that means that stablecoins are solving real world problems. Okay, so you've got that, and then finally the infrastructure side with how much has been built. Every time we have a bear market cycle, people build more. The crypto founders, Web3 founders, DeFi founders are building more and more and more infrastructure in the expectation of if you build it, they will come. And to this point, you had just enough people that were using it to make it profitable, to make it worth doing, to make it worth continuing. And that still continues to this day. But what's really exciting for me is now seeing this great unlock from the institutional side, where you've got protocols like Aave, for example, which are just making so many inroads into the institutional side of trading. Older school players like Centrifuge that have been doing this for such a long time. You've got Visa at the races now, as you know, TradFi with their, with their market monitors that they have around this, because they know where the volumes are going. So tons and tons and tons of upside and momentum here, but still, like I said, so much left to build so that we can have that true bridge from TradFi into tokenized assets and DeFi in general?
Yeah, I would agree here. So, like especially on the infrastructure level, we do see like a major advancement, like especially over the last 1 or 2 years. And now, like also like that the stablecoin issuers or like all the other fintechs developing their own chains, right, for stablecoin transfers. And like touching a little bit more on that, and especially on the infrastructure question here. So on the one hand side, like the claim or the term internet capital markets is like often used by Solana these days.
Yeah.
But how do you see that will develop over the next couple of years, especially if you're talking about like the different blockchain ecosystems? Are they merging more and more together and connected via bridges, cross-chain bridges? Or do you think that there are like rather very few chains surviving all of this and then presenting like the majority of the internet capital markets? And maybe a second part of the question, which role plays privacy actually here? So especially on the institutional level, for example, to avoid front running, you need like a certain level of privacy. However, on chain, everything is more or less transparent and public, right? Yeah, what's your answer to that?
Just to take the second one first, because it'll build into the response on the first question, Jonas, is that absolutely right with privacy is that in our lives and in the traditional financial system, privacy is the default. We don't want people knowing our business. That is your default, right? And it's not just you and me, it's at the institutional level as well, because for things like front running, for things like insider trading, so many other different risks that are there, privacy is the default. With blockchains being pseudonymous in terms of those that are trading on chain, that we need to move into a truly private framework here. And we talk about terms such as zero knowledge proofs or ZK. We talk about terms like KYC or know your customer or KYB, know your business. There are folks that are working on this combination of zero knowledge proofs alongside know your customer, KYC, so that you can prove that you are who you say you are without revealing your identity, or prove a certain credential about yourself. I'm 18. I should be allowed to open an account here. Or I live in a certain jurisdiction, and so I'm eligible to trade this kind of asset. Or I am not on a sanctions list. All of those types of things. And whether that's me as an individual or that is the institution that I am part of and that I have signing authority for as a director, all of that can be baked into a verifiable credential. And that's the way that we need to go with the institutional level. I've talked to founders before that have said, listen, we need to solve this problem about how can we get the big institutions to trade in this DeFi, on this DeFi venue or decentralized exchange, when they're totally at risk of having the counterparty to a trade, even though it's not truly a counterparty, it's just that they're participating in the same pools, that is someone who they would rather not be associated with. And it's, well, you can do permissioned pools, but then you have gatekeepers, and who is the gatekeeper? What is their centralized responsibility? You start to run into all different types of contradictions about, well, this isn't really decentralized finance then. So what do? You try to solve it from a tech perspective. And I think ZK, KYC, as I've been referring it to people with, is the way to go there. I think to answer your second question on what is internet capital markets, to me, it's the full stack. And that is one of the big benefits of trading on chain and having financial systems on chain, is that you can have the same exact infrastructure serving you and me as individuals who are saving and spending on chain and trying to generate some yield on our savings. And it's the same exact infrastructure used by institutions that are trading billions of volume a day. And in order for that to be realistic, we need all three key parts of the stack, or parts of the market, really, to be able to participate here and to be served. So crypto and digital assets in general started at the individual level. You and me trading, holding assets in wallets, and using centralized exchanges, decentralized exchanges, all of that is pretty much the norm now. But for crypto natives, we still have a UX hurdle to get over in order for real world adoption to take hold at the individual level of people having their financial lives on chain. And I think we're going to see an unfolding of a similar path that we've seen with embedded finance, and where people wouldn't even know that they are trading or holding stable coins or trading or holding tokenized versions of different equities or bonds. It will just be, that's their app and that's what they do. I think that's level one. Level two for me is the intermediaries. Stripe, right? Case in point, perfect example. They are now, with their acquisition of Bridge and also of Privy, and then again, their launch of Tempo, they're making it possible for the customers they serve, which started out as small to medium-sized enterprise, running their business on the internet, to now they're servicing financial institutions and the world over. But that core base of theirs, the SMEs, enabling them to live their financial lives on chain and live their business lives on chain. Okay, so that to me is the second level that we really need to open up. The third level is the institutions, and we're seeing tons of activity already there, but it's still really small. If you look at the total market cap right now of crypto, it's about 4 trillion. And the number that we've been throwing around for the longest time in traditional asset management is 100 trillion, probably upwards of 150 trillion these days. Total wealth in the world, including real estate, is upwards of 650, 700 trillion, probably even more. Okay, so we've got a long way to go to get there, but it's a pretty good start from where we came from with Bitcoin way back in 2009. We have 30 billion in tokenized real world assets overall. The majority of that is on the fixed income side, where it's about 15 billion in private credit and about 7 trillion in tokenized treasuries. And then the remainder are a number of different asset classes. That is projected to grow to 2 to 4 trillion by 2030. And that will get us going in the right direction and get us equivalent to where crypto is today for the most part. And then we have stable coins, which are about 300 billion in volume right now, maybe 290, dominated with a duopoly between USDC or Circle and Tether, USDT. We see probably that dropping a bit as more and more entrants come into this place, like with what Stripe is enabling. But I think we're going to see more and more of that. Again, projections for that asset class, stablecoins, is expected to go to 2 to 4 trillion by the same time frame, 2030. And they're all different types of projections that would have that in the region of 16 trillion or 650 billion, but the base case is kind of right there in the middle of 2 to 4 trillion for both tokenized securities as well as stablecoins. So again, all three layers need to evolve and need to continue to move. And I'm looking for those who are building in each one of those three levels: individual finance level, the intermediaries, as well as the institutions.
Yeah, and this actually perfectly fitted into my next question. So I will skip that. But I'm still wondering, what are the bits and pieces that are still missing here? You said, and that's completely right, we do see first real world assets on chain, especially private credit and tokenized money market funds. But if we are looking into stocks, there are many examples where they try to replicate stocks on chain, for example. But it's still not possible to hold a real stock on chain. Also because we don't yet have or don't see the regulatory clarity here, right? So to really enable that and to bring more and more of the traditional financial markets on chain, what do you think is still missing here, on the infrastructure level, on the regulatory level, so that we can really unlock, you said, trillions on chain?
Yeah, I would say, there's two things, and there's two ways to look at this. One is what you should be able to do, right? Or what you base, and there are things that are built with crypto now that allow you to trade in a way that you're not able to trade in the traditional financial markets. Being able to trade 24/7, being able to control all of this through your own personal non-custodial wallet. Those are the baselines for trading in crypto. And with what you guys are building with Trust Bytes, where you've got yield optimization, where you've got hot cold rebalancing, these are things that then need to be overlaid on top of what you can do now with crypto that you can't do with traditional finance. So that makes trading on chain even better, even more efficient, even more options, even more abilities to manage your risk. Okay. So that is the first thing. What is it that you should be able to do because you're trading on chain that you weren't able to do? Okay. And we need to fill those holes because those are the things that are going to make the on-chain experience more compelling, not only for individuals, but for institutions as well as intermediaries that connect the two in the middle. When I say intermediaries, people are going to be like, Pete, wait a second, there's no intermediaries in crypto. I mean, kind of intermediate level. The other thing is that what is it that you shouldn't have to do? Okay. And what you shouldn't have to do if you want to trade an equity on chain is create an SPV in Liechtenstein. Not that there's anything wrong with Liechtenstein. And then have that SPV hold your shares of NVIDIA or Tesla or Apple or whatever. And then that is a balkanized version of the equity markets that then is trading on chain. You should not have to do that. We need truly on-chain issuance. And in Europe, if you look at the CSD regulation, that needs to be evolved in order to enable this. We have jurisdictions like Luxembourg. I think Jersey may do this as well, and perhaps France, where it is legal to have on-chain settlement and on-chain issuance. It's not that it's legal or illegal. It's that that can constitute finality of settlement, an on-chain issued asset with on-chain trading. So we need the CSD regulation or Central Securities Depository regulation in Europe to unfold in that way. The US isn't there yet. The Clarity Act in the US will bring some of that, but we still have a bit of a ways to go because we want the ability for NVIDIA, for Microsoft, for whomever to issue their equity truly natively on chain. Now, some of that is taking place already through Superstate. And I think it's NVIDIA or Tesla, it was Galaxy Digital, that are issuing their own equity natively digitally on Superstate. They're taking one tranche and saying, we're going to issue new equity. Instead of issuing that on NASDAQ or the New York Stock Exchange, we're going to issue that on Superstate. Okay, so there's small examples of this that are already happening, and we need to see more of that. Right now, the SEC is pushing themselves through some lobbying that's taken place in the US to enable crypto exchanges to trade tokenized equities. And what's not clear yet is if that will be a corporate issuer deciding to say, hey, I'm going to issue my equity on this crypto exchange, or if they're going the SPV route of having a custodian hold the equities underneath another layer with an SPV around that then constitutes and it backs a token. Which we don't want. We want that truly native digital issuance. So that to me is the big unlock.
Yeah, hopefully we will see more unlocks like Galaxy. But now let's move on and a bit away from tech and infrastructure and discuss how we should think when adopting this new technology. You've spent years hosting your podcast, Money Never Sleeps, and have explored what keeps founders awake at night. So we're curious because we're turning the tables today. So what keeps you awake at night when it comes to the future of internet capital markets?
That it's moving so fast, and that how do I actually, how do you keep up with it and keep up with the opportunities? Because there's so many builders out there building incredible things. And being able to keep the pulse on the market is where I do wake up at 5 a.m. and say, I got to get up. I got to go. I got to get back into this. Right. And it's like I said, it's a very fast moving space. I'd say also still is just every now and again, you do get the, may not keep you awake at night, but at least it can bring you down a little bit, is some of the toxicity that still gets tossed our way by those that are not educated on the space and what it means. But you grow a thick skin over the years, and it's more of a laugh off these days than it is a taking it personally.
Yeah, we constantly see it's actually maturing a lot, and that's also one reason why we do shows like this. So
Exactly.
let's look back into 2018. You actually wrote about the difference between managing assets digitally and managing digital assets, which was a super interesting article. And where do you think we are now on that continuum?
I think we still have a ways to go. And this to me is towards the true composability of assets, and where real world assets become Lego blocks when they're on chain. And that managing assets digitally is pretty much the norm right now in FinTech 2.0, right? Where you've got the ability to have your own personal portfolio in Revolut or on Robinhood, and you are managing those assets digitally through your fingers, right? Your digits. I know that that's not the point of the term, but that where it is truly digital, and that whole process, at least for you. But behind the scenes, we're still reliant on old school financial infrastructure for all of that to actually be supported. We see the same thing at the institutional level, where we've got huge portfolios in the billions and in the trillions still being supported by enterprise software that is FinTech 1.0. And so there's a ways to go there. And managing digital assets, we see crypto funds that are holding all different types of crypto assets. And whether that is, the originals like Bitcoin or ETH or Solana, or that's tokenized treasuries or tokenized private credit, as I mentioned, that is managing digital assets, because you're managing assets that happen to be issued digitally. And there's more things going. There's a lot more to do there in terms of the technology side to be able to get that right. You need to be able to support that. I think with where we are right now between managing digital assets, what's grown since 2018 has been the financial markets in general. And yes, crypto funds have grown, but we're still at only about 30 billion, as I mentioned before, in real world assets on chain. We do have the 4 trillion in crypto assets in general. Okay. And that has grown, but it grew from 2018 to what was it back then? 2 trillion. So it's basically doubled. So we haven't seen the huge hockey stick growth yet in terms of managing digital assets. But as more and more and more assets move on chain, my vision for this whole space is that within the next decade, we will see cash, securities, and any type of asset by default will trade and settle on chain. They will also be issued on chain. And all of TradFi is the TAM for this opportunity. Okay. So that I expect that by the time, I'm retiring from this space, I don't know when that's going to be, but hopefully in the next 10 years, that we'll see that the majority of assets around the world are trading on chain by default. Just in the same way that we hit the default where, we still have DVD players, but the majority of the world is streaming. We still have VCRs, even if people may not remember them. But I think that's the context of where we're headed to with this.
Yeah, for those listeners out there, so Pete just predicted the future, and he's actually good in that, because as an investor, you need to do that in a way. So one final question from my end before we go into a fun round. Actually, what advice would you give to someone entering this field now, trying to build or invest in the next generation of financial infrastructure?
You got to do your own homework. You got to do your own research. Find a thread to pull on and get your pro subscription to ChatGPT or whatever AI tool is going to be your whatever tickles your pink, right? So what we need to do is just get people to experiment, get people to figure out this space. Deposit a bit into a liquidity pool on Aave to earn interest on a stablecoin, to earn interest on USDC or Tether, and to earn yield, and to see what that's like, and see this coming into your wallet real time, real time ticking P&L, as we call it in the old school finance world. So play around with it, and do, something like ChatGPT can help you with your research immeasurably around this, and be able to give you the things that you need to be careful of, and watch out for this, watch out for that when you're opening a wallet for the first time, and those types of things. So I think that's a big ask from me, is just experiment with the space, but do so safely with, a couple hundred that you can afford to lose. Because if you send it to the wrong place, it's all gone in a second. And that's one of the big things. Like I said earlier, we still need to get the UX right around this, and the security and the controls right around this for the mass market.
All right. Thank you so much. Let's play that game, because it's coming. And now let's do a little quick fire. I give you a few questions. You have one word each to answer them.
All right.
A single word that describes the future of finance.
On-chain.
A book or thinker who most influenced how you see finance.
Balaji Srinivasan.
A misconception about crypto or DeFi you wish would disappear.
It's all degens.
Who would you like to see next on our show?
Balaji Srinivasan.
What would you build if regulation and funding were not a constraint?
Okay, I haven't read his book yet, but I've done so much reading about his
One
book.
word.
Balaji Srinivasan's DeFi Matrix, where you can trade any
Okay.
asset against any asset in the world.
Great. Thank you.
Okay, Raji, we will reach out. Just keep that in mind. Last but not least, how do people find you? And do you have like any final words before we wrap it up?
Yeah, people can find me on Twitter. I'm at Pete Townsend NV. I'm also on LinkedIn and active there. And if you have any questions about the fund and where it's going, it's info@NorioVentures.com, and you can hit us up there. And the final word is just, I've been in this now for 10 years. I've never felt the momentum be stronger about where we're heading with bringing finance on chain. And I am just very much welcoming the opportunity now to continue to work with unstoppable founders like yourselves, Jonas and Jeremy, as we move into the next stage of financial markets.
Perfect. That was
All
fun.
right.
Thanks a lot,
Thank you
Pete.
so much.
My pleasure. Anytime, guys.
That wraps up this week's episode of Internet Capital Markets. Thank you, Pete Townsend, for joining us and sharing the insights on the shift from traditional to truly digital markets, and what it means for founders, investors, and institutions. If you enjoyed today's discussion, make sure to subscribe, rate, and share the show. It helps us to bring more conversations with the people sharing the future of on-chain finance. This is Internet Capital Markets. Join us next week as we continue exploring how technology, capital, and human creativity converge to build the financial system of the future. Until then, stay curious. You've heard it. Learn, educate yourself, stay connected, and keep building the future of finance. Bye-bye.